In this last video of the lesson, Pricing and Valuation in Life Insurance, we will learn about surplus and bonus and how it affects the insurer and the policyholders. The following topics will be covered here. Let us begin by understanding the basic concept of surplus and bonus. Surplus is the excess of value of assets over value of liabilities. If it is negative, it is known as a strain. Every life insurance company is expected to undertake a periodic valuation of its assets and liabilities. Such a valuation has two purposes. First, to assess the financial state of the life insurer. In other words, to determine if it is solvent or insolvent. And second, to determine the surplus available for distribution among policyholders or shareholders. The assets can be valued in the following ways. First, at book value. This is the value at which the life insurer has purchased or acquired its assets. Second, at market value. This is the worth of the life insurer's assets in the marketplace. And last, at discounted present value, which is estimating the future income stream from various assets and discounting them to the present. Now we will look at the process of allocating the surplus. Whenever the surplus arises, the life insurer is obliged to pass on this benefit to policyholders who have purchased these with profit policies. At the same time, surplus is also a source for increasing the company's basic capital. It contributes to the life insurer's financial soundness. Let us now look at the methods of allocating the surplus. First, solvency requirements. Life insurers have to maintain a solvency margin, which may be defined as the portion of surplus assets over liabilities that are specifically set aside to serve as a cushion to meet any unforeseen deviations between expected and actual experience. And second, free assets. Another purpose for having surplus that is unallocated is to increase the level of free assets. Free assets are unencumbered, that is, they are not required for meeting any specific liabilities. The life insurer is thus free to use them for various purposes like business expansion, etc. Now that we understand what surplus means, let us take a look at what bonus is and its types. Bonus is paid as an addition to the basic benefit payable under a contract. The most common form of bonus is the reversionary bonus. It is called reversionary bonus because the policyholder only receives it when the contract becomes a claim by death or maturity. The various types of reversionary bonus include: first, terminal bonus. This bonus attaches to the contract only on its contractual termination by death or maturity. The bonus is declared only for claims of the ensuing year without any commitment about subsequent years. Thus, the terminal bonus declared for 2013 would only apply to claims that have arisen during 2013-14 and not for subsequent years. Terminal bonus depends upon the time duration of the contract, and it increases as the duration increases. Second, super compound bonus. In this, the bonus is arrived at as a percentage of basic benefit and applying another percentage for attached bonus. Third, compound bonus. Here the company expresses a bonus as a percentage of basic benefit and already attached bonuses. It is thus a bonus on a bonus. A way to express it may be at the rate of 8% of basic sum assured plus attached bonus. And fourth, simple reversionary bonus. This is a bonus expressed as a percentage of the basic cash benefit under the contract. In India, for example, it is declared as amount per thousand sum assured. Let us now understand the contribution method. Under this method, consideration is given to three sources of surplus: excess interest, mortality savings, and savings arising with respect to expense and other loadings. The surplus is thus given by the difference between what was expected to happen and what actually happened over the year with respect to mortality, interest, and expenses. Finally, let us look at unit-linked policies and its principles. ULIP premium comprises of policy allocation charge, investment risk premium, and mortality charge. They involve a different approach to design the products and follow a different set of principles, which are as follows. First, unitizing. The distinctive feature of these policies is that their benefits are wholly or partially determined by the value of its units credited to the policyholder's account at the date when the claim payment is due. Second, transparent structure. Policyholder benefits do not depend on the assumptions and discretions of the life insurance company. The structure should be made transparent. Third, pricing. In unit-linked policies, the insured decides what amount of premium he or she can contribute at regular intervals. The insurance cover is a multiple of premiums paid. And fourth, bearing of investment risk. The investment risk is borne by the policyholder. Since the value of the units depend on the value of the life insurer's investments, there is a risk that these unit values may be lower than expected. The life insurer does not give any guarantee about the unit values. Here is a quick look at the topics covered in this chapter. Thank you.